Hi, I'm Ralph, and I'll be presenting question 1A, which is the adjusting journal entries required for the consolidation worksheets at 30th of June 2023 and 30th of June 2024. I'm going to be focusing on the intra-group transaction between Illawarra Ltd and Milton Ltd. First, the journal done in 30th of June 2023. Illawarra sold inventory to Milton for with a 20% markup, giving an unrealized profit of $1,000. And after one fourth remained unsold at 30th of June 2022, but by June 2023 it had been sold. So the $250 profit that was unrealized last year is now to be reversed from retained earnings, with the tax effect being $75, 30%. Milton sold a tractor to Illawarra for $25,000 with a profit of $5,000. This profit is unrealized from the group's perspective, so it is to be reversed along with its tax effects. We also adjust for excess depreciation. Illawarra depreciated more than Milton would have. The excess depreciation over 2 years is $725. For Part C and D, there are no entries needed for 30th of June 2023 because they both were transacted the next financial year. Now on to the 2024 journal entries. For Part A, there's no more unrealized profit that exists in inventory as at 30th of June 2024, so there's no journal entries. For Part B, the third year excess depreciation needs to be recognized, which amounted to $387.5. Part C, Illawarra sold a non-current asset to Milton for $800, and there was $200 unrealized loss that should be accounted for. This creates a deferred tax of $60. Finally, for Part D, we eliminate $300 of intra-group rental income and expense.
My name is Harvey. Now I will go through the question 1B, which is required to do a consolidation worksheet for Yarrala Ltd on 30 June 2025. First, we do the acquisition analysis on 1st July 2022 to compute the goodwill. We compute the fair value of identifiable net assets by adding up all the equity of Lorry Ltds and the fair value adjustment for those identifiable assets and liabilities. For example, plants, lands, inventories, brands, and quantity payable. The total fair value of identifiable net assets is 295,200. Next, the consideration transfer is the price that agreed by Yarrala Ltd to buy the shares of Lorry Ltd, which is 330,000. But we need to further reduce by 1,000 because there is a dividend payable that announced before the acquisition date. Therefore, the final consideration transfer is 320,000. Lastly, we compute the goodwill by using consideration transfer, deduct the fair value of identifiable net assets, and there is a goodwill of 24,800. After that, we prepare the consolidation worksheet entries. In this process, we will record all the business combination value entries which require to adjust the carrying amounts of the subsidiary assets and liabilities to fair value. Afterwards, we make the pre-acquisition entries to eliminate the carrying amount of parents' investments in each subsidiary against the pre-acquisition equity of the subsidiary. Lastly, we can make the consolidation worksheets by combining both financial statements and making the relevant adjustment for each account according to the consolidation worksheet entries that we did before.
In this report, the recently implemented IFRS Section 1 and 2 were discussed in terms of limitations, values to stakeholders, and its successfulness in creating a baseline for sustainability reporting. Reporting can be influenced by many factors, both internal and external to the company itself. To briefly give some context, IFRS Section 1 relates to sustainability practices and how they impact reporting. Disclosure is required in terms of governance practices, strategies to manage risks and opportunities, actions to mitigate risks and seek opportunities, and entity or state required targets regarding sustainability practices. IFRS 2 is similar in terms of disclosure requirements. However, the risks and opportunities associated with this relate to climate change and how this can affect reporting and measurement. Both were updated in recent years, effective as of January 1st, 2024, as an optional requirement. Additionally, if an entity chooses to apply one section, the other must be applied also. It is important to note these disclosures are a qualitative aspect of reporting. The Australian Accounting Standards Board published their iteration of IFRS 1 and 2 on the 20th of September 2024 under voluntary circumstances, taking effect on January 1st, 2025. To examine these standards, we discussed the limitations these IFRS standards have and that have been identified by multiple journals and articles to assess the potential value stakeholders gain from disclosure. Stakeholder perspectives were discussed in a report published in October 2024, highlighting the point that sustainability reporting is not considered as mandatory from the IFRS. Additionally, stakeholders do not believe the IFRS Foundation is necessarily inclusive to encompass all kinds of stakeholders and is mainly investor-oriented. Noting that reporting may require a cost element, this non-mandatory part of disclosures poses a question surrounding whether entities believe sustainability disclosure is worth the cost-benefit perspective.
There are also some scholars questioning how IFRS frameworks will interact with other international standards. So a particular example of this is the European regulators and their use of double materiality. So while both frameworks cover risk management, governance, and performance metrics frameworks, the S1 and S2 standards use a single lens of materiality. This means that they only examine how sustainable initiatives can impact financial outcomes. European regulators also use this, but they also consider how the actions of their company will impact the environment, which is called double materiality. So the studies that me and Alexis have spoken about all indicate a very diverse range of perspectives on the implementation of IASB standards in financial reporting. As implementation is still in the early stages, its goal of becoming a global baseline of reporting hasn't been achieved yet. Further implementation is hindered by its financial-only approach to materiality and its voluntary nature, which makes consistent application of the standards quite difficult, especially overseas. Underdeveloped or under-resourced jurisdictions could experience difficulties in meeting mandatory reporting obligations, especially if they haven't already begun to implement sustainability initiatives. On the other hand, some jurisdictions that have already implemented frameworks might perceive the S1 and S2 standards as a regression. The European Union's use of double materiality is a good example of this. Although implementation in Australia is a step towards positive environmental change, the lack of existing legislation and financial reporting standards is evidently an existing barrier to adoption on a global scale. But future research should investigate the percentage of entities who have chosen to apply these standards in their reporting and whether stakeholder feedback is positive or negative. This could provide a baseline regarding how many entities have chosen to report on sustainability initiatives and whether this is perceived as positive change by all stakeholders, not just investors. As research on this topic is primarily qualitative, it's hard to obtain data which indicates the impact of these standards on financial reporting as a whole. So sustainability reporting provides valuable information for stakeholders to analyse and understand the entity's processes. The perspective of stakeholders is a beneficial factor in this reporting and has shown that reporting is not inclusive to all stakeholders. It's primarily investor-oriented. The international application of these standards was another limitation that was identified, arguing that there is a narrow focus on financial-only outcomes. In its early stages, IFRS 1 and 2 do not have a strong baseline for consistent application across entities of different sizes and scales, and further research should be taken to investigate how other stakeholders and investors perceive this reporting inclusion. This will indicate the degree of value this has for Australian investors.
For my reflection, our group, I think, collaborated well by dividing sections according to each member's strengths. We held short-in meetings and we used shared documents to track our progress. Everyone contributed and we helped each other through difficult concepts. One challenge for me was keeping track of timing, especially with the intra-group sale of the tractor and when depreciation needed to be adjusted. I overcame this by carefully thinking through the depreciation year by year and checking the impact on both companies.
What I found challenging about this assignment was definitely finding the right research to break the question down. There's so many different perspectives and angles, and a lot of it was opinion, and it's also quite new, so it's hard to find research because all of it's quite recent developments, so it's hard to find certain arguments and certain limitations to the actual question. So how has my thinking about accounting changed? Completing this assignment definitely allowed me to understand accounting a little bit better. I found it quite interesting how other countries have already adopted a lot of sustainability criteria and frameworks and have already mandated sustainability criteria into their reporting, which I found was quite interesting, whereas in Australia it's not as developed in the same way, and it was interesting to see how other countries struggle with also implementing that criteria, which has changed my perspective on that.
This assessment task challenged the standards of accounting and forced us to look at issues to form multiple perspectives. This was the thing that was the most challenging in terms of thinking, as it created an ethical perspective to accounting, while we also looked at the logical side with the calculations in question 1. This was an interesting contrast to look at and investigate, and it showed me that there are parts of accounting that aren't necessarily concrete, and there are things that need to be updated for the current economic landscape we live in today. The topic's research changed the thinking that standards are always valuable to everyone, which is part of the reason why they are a requirement. However, perspectives and limitations identified reading these articles and journals show that there is still room for development.
My opinion, the most challenging part of question 1B is how much you can understand for the question. For example, the transaction for plant, inventory, and lands have confused me because I initially recognized them as internal transaction, but there is not enough information for making the adjustment, so I stuck in this step for a while. Besides, I think the accounting process will increasingly rely on AI-driven systems in the future because they provide an efficiency way to complete the task. Therefore, it can reduce the cost of company and save the time. As a result, accountants must keep learning by taking CPA to stay competitive in the industry. Moreover, accountants must continue to improving their professional skills, especially communication skills, because AI so far still cannot provide emotional support in a face-to-face conversations, so it will be a dominance for us. That's all of our presentation. Thank you.